We'll keep this market conversation going. We're joined now by Alan Nuckman, Chief Market Strategist at Bullseye Option. Alan, thanks for being with us. And I wonder, what's your reaction to the fact that those early gains just could not hold? Really, if you want to get technical about it, if we're going to pinpoint it on that Fed official comments, all she was saying was that the Fed wouldn't rule out, let's say, a 75 basis point hike. I'm not sure there really is a strong change in language, but it is a sensitive market.
Right, and I won't rule out that we're at the bottom end of the range. We could put in a bottom anytime soon. But as a price watcher, I don't like the way the markets react. It's become a sell the rally type market. And the psychology and sentiment right now, we've got serious problems. You're talking about everybody's so worried that things were too strong and there was too much inflation. On the other hand, their answer to that is that we're going to roll into a recession. If you look at the fundamental facts, they're all super positive. 80% of earnings, 80% of companies that beat earnings, 75% of those beat on revenue. And you've got the PE ratio right now down at 17, which is below the 5-year average. And now we're almost to the 10-year average in PE. So stocks have gotten cheaper. So I don't know where the worry is, but it's really a psychological and a sentiment issue.
And I wonder if it's some of those folks who were staying bullish who now have to acknowledge or be more cautious in sort of their positioning. I was thinking about all the Wall Street strategists. Morgan Stanley had really stood out as a very bearish firm, and then you'd have these sort of competing views from other shops. But Bloomberg's been reporting on how those Wall Street strategists, whether you follow those calls or not, that they are increasingly putting out more cautious comments as we go through the year, because clearly they don't want to be wrong about where the markets go.
Right, but we all know rates are going to rise. We've been talking about this for months and years. They're going to top out at 2.5% or 3%, still historically ridiculously low. So it's not going to bring the economy to a screeching halt. And to give you an example of this strangeness in sentiment, what were we worried about? Crude oil being too high. Now we're worried that crude oil's come too low. It's trading now between 110 and 90 here for the last 2 months. 100 is a pivot point to keep an eye on, but I use crude as a barometer of economic strength. So higher crude prices, even here at these levels, are about half of the 2008 high if you adjust for inflation. So there's a lot of mixed signals, but if you follow price, we had some great setups. Last Monday, we made new lows and had a higher close. And we had bullish versions of the fact that volatility didn't make new highs. So these were all positives, and we built it on Wednesday when we had that relief rally, when we finally raised rates, and it was a reality. So after that, you saw some unwind and continued unwind, but it's happening on lower volume, and the volatility is nowhere near that 38 high. So a lot of things are technically telling me that some of the worst may be over, but the market can never hold any of these bounces. That's what concerns me.
And before I let you go, our audience hears all sorts of stuff. I'm sure there are others out, well, certainly there are others out there that feel like you do, that perhaps the selling pressure has set us up for a return to an interest in equities as we roll through the year. But what you buy, do you stick with that stuff that had done well in the first couple of months of this year? Do you look at those hard-hit growth stocks? What would be your message to our audience about how you should be navigating through this market right now?
Well, for me, it's not what I trade, it's how I trade. I'm very optimistic. I like the risk reward on a lot of stocks. There are so many things to look at now, whereas when the market was on a tear forever, it's harder to be a buyer and look for that because there's going to be a pullback at some point. What I like to do is position with options. So I buy long-term options I'm looking September, October, December, and January. Plenty of time for the market to sort itself out. Let's remember, it was only a couple months ago that were all-time forever highs and everyone was very, very optimistic. So I look to buy in-the-money options as my strategy, as my stock substitution strategy. Instead of buying stocks at these lower levels, buy in-the-money options that have plenty of time. They're going to act like the stock. It ties up less money, and it produces a better payoff on just modest moves to the upside. So that's how I position myself. I still think there are great opportunities here at these levels with all these stocks at discounts. But what's so interesting is so many people now have their hands down, and they don't want to be buyers at low levels, but they didn't want to be buyers because the markets were too high. So again, that's the psychology that is very screwed up at this time.